Hello, and welcome to OGE's training for reviewers of nominee public financial disclosure reports. I am Jack McDonald. In today's session, I will address identifying and reporting different types of investment funds and making an accepted investment fund, or EIF, determination. In this presentation, we are using real-life examples so you can have a better ability to practice, but this does not in any way imply an endorsement of any fund. Let's begin with a quiz. An asset identified as BlackRock Diversified Income Portfolio has the following description. It seeks to generate income by investing in a broad range of asset classes. This opportunistic approach may be appropriate for investors looking for income and growth potential while managing volatility. The portfolio primarily invests in exchange-traded funds diversified among traditional income sources, such as stocks and bonds, as well as non-traditional income sources, such as real estate investment trusts and bank loans. True or false, this asset is an accepted investment fund? The answer is false, because this investment is actually a managed account. Often there are a few clues that can help you identify a managed account. In this example, the word portfolio in the name of the asset and the fact that the portfolio holds a variety of asset types should provide enough clues to make you question the type of asset. Let's learn more about managed accounts before we take a look at investment funds, because a managed account is often mistaken for an investment fund. When you hear or see the word separately managed account, also known as an SMA, controlled account, or a robo-advisor account, you know you are dealing with a managed account, not an investment fund. With a managed account, the investor gives the financial advisor the discretion to buy, sell, and trade investments on behalf of the investor. An investor usually chooses among predetermined portfolios based on a particular investment strategy, which financial institutions sometimes package into categories such as high yield, balanced, large cap, global small cap, strategic fixed income, and other similar descriptors. The investor can usually customize the portfolio to some extent, although this is not necessarily the case with all managed accounts. I wanted to have you see this information at the beginning of my presentation because my training today is focused on investment funds, and reviewers sometimes mistake a managed account for an investment fund. So it is very important to look up the names of assets and to be able to verify the exact name and type of asset to avoid going down the wrong path. How are managed accounts reported? Well, here are two examples from the OGE's Public Financial Disclosure Guide. For option number 1, the filer simply lists the name of the asset held in the account according to the appropriate reporting instructions for the asset. For option number 2, in addition to listing the assets in the account, the filer may provide the name of the managed account and the financial institution at which it is held, but this information is not required. Now let's take a look at investment funds. Unlike managed accounts, where the investor owns the individual assets in the account, an investment fund is a fund that has many investors who have pooled their money together to take advantage of an opportunity for better gains on their investment. That is why you will often hear the term pooled investment fund. This slide shows our universe of investment funds, and these names should all look pretty familiar to you. A mutual fund is a company that is created and managed to hold a portfolio of securities as an investment company registered with the U.S. Securities and Exchange Commission under the Investment Company Act of 1940 as amended. Mutual funds are very common on financial disclosure reports and have 5-letter ticker symbols. Investors purchase shares of the mutual fund, and the value of those shares typically rises and falls based on the performance of the mutual fund's underlying investments. The underlying investments of the mutual fund may include shares of companies in a variety of business sectors, bonds, cash equivalents, etc. An exchange-traded fund, or ETF, is a fund that pools investors' money in a variety of investments. Unlike traditional mutual funds, most investors buy and sell shares of ETFs from other investors on an exchange rather than directly from the issuer. In addition, ETFs cannot market themselves to consumers as mutual funds because they are not necessarily subject to all the requirements applicable to traditional mutual funds. Nevertheless, ETFs are usually registered with the U.S. Securities and Exchange Commission under the same authorities as traditional mutual funds. ETFs are also very common on financial disclosure reports, but have a ticker symbol with 2 to 4 letters, but many have 3-letter ticker symbols. A hedge fund is a limited partnership of investors that uses high-risk methods such as investing with borrowed money in hopes of realizing large capital gains. A private equity fund is a pooled investment vehicle where the advisor pools together the money invested in the fund by all the investors and uses that money to make investments on behalf of the fund, typically in private companies. A critical element to reporting an investment fund is the reporting concept known as Accepted Investment Fund, or EIF, which reduces the amount of information required to be disclosed on a financial disclosure report. Please remember that the E in EIF does not mean exempt and has nothing to do with your conflicts analysis of a particular asset. So when you hear someone say that a filer holds a lot of EIFs, which are not a problem, they are missing a critical point. The EIF status of an asset reduces the disclosure burden for that asset, but you still have to look at the actual investment itself for a conflicts assessment. Let's take another quiz. Which of the following is not necessary to establish that an asset meets the standard for accepted investment fund? The filer neither exercises control over nor has the ability to exercise control over the financial interest held by this asset. This asset is publicly traded or available, where its holdings are widely diversified. At least 100 individuals have invested in this asset. This asset must be a pooled investment vehicle. This asset must be registered with the SEC. None of the above, that is, they are all elements of an accepted investment fund. The answer is E, because an asset does not have to be registered with the SEC in order to qualify as an EIF. In order for a fund to qualify as an EIF, the fund must meet the following criteria. The fund must be independently managed, widely held, and either publicly traded or available, or widely diversified. Let's take a closer look. For step 1, an investment fund is independently managed if the filer lacks the ability to exercise control over the financial interests held by the fund. For step 2, a fund is widely held if the fund has at least 100 natural persons as direct or indirect investors. Here we mean individual investors. We count heads. For example, if a fund has a few individual investors and one of the investors is an investment partnership called XYZLP, we add all the individual investors plus the investors in XYZLP together, both the direct investors in the fund and the indirect investors through the XYZLP. A company's pension fund is another great example. If a pension fund is one of the investors, we count each participant in the pension fund as an investor. These types of investors can easily push the number of investors to 100. For step 3, a fund is publicly traded if it is listed on a national or regional exchange in the United States, such as the New York Stock Exchange or the NASDAQ. A fund is publicly available if it is or was ever open to anyone who wants to become an investor. It's okay if the investor must have a minimum net worth requirement, make a minimum investment, be an accredited investor, or if the fund was publicly available but is now closed to investors. An example of a fund that is not publicly available is a retirement fund specifically created for an employer, such as a law firm or company, that is available only to the employees of the law firm or company. Another example of a fund that is not publicly available is a family partnership. It is important to note that these examples of non-publicly available funds are often also not widely held because they may have less than 100 investors or members. Remember, if your investment is publicly traded or available, the investment does not need to be widely diversified in order to qualify as an EIF. For example, mutual funds on the market are publicly traded or available, which means that you do not have to determine whether such a mutual fund is widely diversified. If you have some other type of investment that is not publicly traded or available, you will need to determine whether that fund is widely diversified. An investment fund is widely diversified if it does not have a stated policy of concentrating its investments in any industry, business, or single country other than the United States, or bonds of a single state within the United States. Here's an example of a fund that qualifies as an EIF. The filer simply reports the fund's name, answers yes to the EIF question, and discloses the value and income amount. However, if the fund does not qualify as an EIF, you can now see all of the additional information required for the financial disclosure report, the fund's name, plus a complete breakout of the underlying holdings. So you can see the great difference here in the amount of disclosure and why you need to fully explore whether you can get to EIF for the disclosure of an investment fund. Now, what happens if a filer owns a fund that does not qualify as an EIF and the filer cannot report the underlying holdings? OGE issued a legal advisory, LA 1405, addressing this situation for individuals nominated by the President to Senate-confirmed positions, PAS nominees. My discussion here will be based on the advisory, which focuses specifically on the situation in which a PAS nominee is unable to disclose the holdings of a pooled investment fund that does not qualify as an EIF. Based on that guidance, if the fund manager will not disclose the fund's holdings to the filer needs to obtain a fund manager letter to verify this fact and provide it to the agency and OGE. OGE can provide an agency with a sample fund manager letter if needed. In addition, the filer will have to indicate on the 278E that the underlying assets are not ascertainable. In this case, the filer may retain the fund unless the circumstances change. If the filer has knowledge of the assets but is unable to disclose the holdings of the investment fund due to a confidentiality agreement, the following requirements apply. The confidentiality agreement must be in writing and must be binding. The confidentiality agreement must unambiguously require non-disclosure, and the confidentiality agreement must have been in place before the nominee knew he or she was being considered for a government appointment. In this case, the agency reviews the confidentiality agreement to see if it meets these criteria. It should be noted that a fund with a confidentiality agreement presents a difficult situation because the filer has knowledge of the fund's holdings under 18 U.S.C. Section 208, but neither the ethics official nor the public knows the holdings. So in this case, divestiture is the appropriate remedy, and the nominee will have to indicate the following on the 278. Underlying assets are not disclosed due to a pre-existing confidentiality agreement. I will divest this asset if confirmed. A final item related to investment funds concerns capital calls. If the filer is invested in a hedge fund or private equity fund, don't forget to ask if they have any capital calls to report. A capital call is money that the investor has promised to contribute to the fund for future investment purchases by the fund. A capital call is reported as a liability, as it appears on the slide. For the amount, you need to report the category that corresponds to the highest value of the liability during the reporting period. With respect to a capital commitment, this will be the total amount the filer committed to the fund when they signed the agreement, minus any amount they already contributed prior to the reporting period. The rate will normally be reported as 0% or NA, and the term is reported as on demand. Thank you, and I hope you have found this to be an informative training session.